welcome, everybody. We are back, your friends at the Legacy Wealth Capital Group.
We don't play that because it's like we don't care what's going on. We make it happen.
The office pretty much depended on us. If we didn't work, the office didn't work, basically. It couldn't function without us.
I think about like, what could we have done different?
And you could follow that model with your product.
Your service will not sell because people are going to feel that conversation.
What's happening, good gentlemen? We are back again, your friends at Legacy Wealth Capital Group, and we got a good one in store for you. I know we talk about the Regulation CF, equity crowdfunding, raising $5 million in a year, but what does it really take to do a successful raise? With everything that we do, there should be some type of checklist, something that you can get a step-by-step playbook to launch successfully. Now, does it mean that you're going to do everything that you want to do? No, because nobody can predict the markets. You can't predict the time of the season that we're in. And so what we want to give you today is, first and foremost, educational, informational content. Before you launch a CF, you need to talk to your securities attorneys, your corporate attorneys, accountants to make sure that you set up everything that you need in order to do this successfully and legally. So everything that we're explaining to you here is educational, informational only. Always consult with your legal providers and if certified or accredited financial advisors to help kick these types of things off. Kyle, Sean, how's it going tonight?
Good.
Great.
Busy day.
Yeah.
Give us a word of wisdom. If you were, for any business owner, for any startup, for any CEO that's listening, and they wonder why should I even be interested in a Regulation CF? From your guys' perspective of raising capital before the Reg CF really popped out, give me a word or two of why this is important.
It's important because for especially smaller companies, right? Revenue and capital, et cetera, is one of the main parts of the business because a lot of businesses go out of business because they don't have capital. So when you're able to raise capital, for example, raising $5 million with a Regulation CF, you're able to, move your company along without having the revenues to keep your company going. Does that make sense? So that's my little short answer there.
Yeah, I mean that's basically it. 95% of small businesses go out of business within the first 5 years. Well, what's usually the reason that they went out of business? Lack of funding. So I mean, if you don't know how to raise capital, and not only that, but know how to raise it properly, the likelihood of you trying to live the American dream is going to be short-lived. And not only that, you're probably going to jump out of the frying pan and into the fire because what did you use to get there? Probably you mortgaged your house. You probably took out credit. You probably did a HELOC and get, a loan or whatever. Your 401k plan. And guess what? You ain't got no way to get that back.
Yeah, I think there is and I did a podcast recording earlier today, and we were just talking about, and I mentioned that, Regulation CF, these crowdfunding raises, people need to think about it as another tool in their toolkit. Everything doesn't have to be a hammer. Everything doesn't have to be a nail. And what we often have been taught is one path of getting capital, or two, bootstrap and then go get a bank loan. And so we don't have to live with only a limited, it's just limitation. And I fault everybody that's in a position to tell somebody something different and they won't. Whether you want to get the business, there's more than one ways to reach a goal, and this is one of them. And so as we go through this checklist, I'll pause every now and then, Kyle, Sean, so you guys can jump in. But I want people to really pay attention to just the steps that it takes to launch one of these. Because once you learn how to Kyle's point, once you learn how to raise capital, no matter what tool you use to raise capital legally, you don't have to worry about running out of money in your business ever again. And we talked about that last night with when should you be raising capital all the time, and you should be prepping, and you should understand the burn rate of your business. What's that monthly burn? And when you're getting close to running out of money, you're raising capital until your revenues get to a place where they sustain you. And even then, you got Elon Musk raising capital, and he got money, and his company's got money,
Yeah.
and still raising capital. So we got to look at the blueprint. We got to look at the blueprint. So let's jump into this thing. So tonight, what we want to give you is the Regulation CF launch checklist, your step-by-step guide to launching a successful equity crowdfunding campaign. The content in this presentation, again, is for educational and informational purposes only. Always seek legal advice and CPA advice when you're doing these. So we're going to cover what you need to launch, financial requirements and audit thresholds, required service providers, SEC filings and compliance, platform selection, security structure, company readiness assessment. What are the benefits? You can raise up to $5 million annually from both accredited and non-accredited investors. You can build a community of brand advocates. It's simpler than a Reg A Plus or traditional IPO. And it's almost, you can look at it as a stepping stone. And you can turn your loyal customers into investors. And once you have a customer that also invests because they believe so much in your business, they're going to keep being a customer because now, and it just creates a circle of I'm supporting you both from I'm using your products or your services, but I'm also funding and helping the business grow as well from an investment standpoint. So they're bought in. Financial statement requirements. Goes back to where Kyle talks about jumping out of into a frying pan. A lot of people want to raise money and get money from family and friends, and you don't really structure it properly. But depending on how much you want to raise in a Regulation CF, you may need to have either certified financials, CPA review financials, or audited financials by a third party CPA firm. And so, as you can see on the left, you have different raise amounts. And I'm not going to read it all. You can see it on the screen. But if you're going from 0 to 124,000 and what you want to raise, you can certify that your financials are correct as a CEO, as the owner, and you have to submit some tax return information. Above 124,000 to about 618, CPA review financials. 618 to 1.2, CPA review or audited. And if you've done a CF before, you have to have CPA audited financials, and over 1.235 CPA audited, meaning you have to go to a firm that's separate from your accounting firm and have them audit your financial statements for accuracy and truth. And now I do want to say at the time of this was the requirements. SEC is always looking at laws and they modify and change. So depending on when you hear this, they may have done an update. But for right now, those are the rules as far as financials. Bless you, sir.
Excuse me.
I think this is important, Kyle, because you talk about American greed. You talk about the people ending up on your favorite show.
Favorite show.
I think a story, and I don't like to jump on social media stories a lot, but when we hear about Jay Morris with the Tulsa Fund, TREF, and him filing bankruptcy and people talking, or the previous times he filed bankruptcy, and now the fund is not doing so well, and they talk about what he did with the money, mismanagement, all the things. This is why it's important to have the audited financials, the CPA and accountants on your team, because when you get a whole lot of money hit your bank account from investors, it is your duty to do what you say you're going to do with that money and to keep up with it. Kyle, talk to us a little bit about why people end up on American Greed.
Yeah, well, when you take that responsibility as the CEO, the CFO, the COO, anybody that's in there, controlling money, the controller, um, that's a job. That's a whole nother job in itself. Dollars coming in, shares being bought. You got to keep up with the shares. You got to keep up with the investors. Make sure you got the right addresses. Make sure you. Back then, we were doing certificates. We were mailing the physical paper certificates out. Now we have digital certificates, but still, you got to make sure the numbers are right. Shares add up to what you're doing. I mean, that's a job, and it's so important to do that. And then not only that, when they read the subscription docs or whatever, whether it be the PPM or the Form C, and it's going to say estimated use of proceeds. And when it says that, then you kind of have a description there what you're going to be doing with these proceeds: marketing, officer salaries, talent hiring, equipment, manufacturing, marketing, whatever. Um, you got to be on point. There's nothing in there that says Escalade, what I'm saying, trip to Tahiti, you know what I mean, getting that Harley Davidson. Ain't none of that in there. You know what I mean? So all of a sudden, here it is. You open up a business, you start raising capital, and then 6 months later, you got a Harley. You got a hog. Like, how'd you get that? You making that kind of money? Nah. There you go. You're gonna be on my favorite television show.
Sean, you want to add anything to that?
I mean, Cal pretty much said it all. I believe that when people are raising capital and it's a successful campaign, and it's large amounts of capital coming out, you have some people that have a bit of greed in them. So now they're like, well, man, I can do this, which I've never done before. I can party, I can do this, and they'll make it seem like, how like when you do like business expenses, they'll throw a party and that'll be a business expense.
Right.
Or they'll go out to Vegas and that'll be a business expense.
Right.
And it's all coming from raising, investors' money. I was just about to mention Enron. Enron, wrote it off as business expense and stuff like that, and they had financials was all screwed up. But you get some people that they become greedy, and they don't understand that the true wealth isn't from it's not necessarily the capital raise. Like, you may raise $100 million, right? But the shares you have in your possession may be worth billions of dollars. So they'll press their luck and try to, steal the money that's coming in, not understanding where the real wealth is made, and it's on your shares. So I just believe that there's a lot of confused and greedy people out there, and if you want to lead your company and have a successful company, you can't be greedy. That's one of the things that kill a lot of deals is greed. So you can't be greedy, and you got to do what you're going to say. You got to do what you're going to say you're going to do with the funds.
So, yeah, I think, Sean, it's so true. And let's just call a spade a spade. People are too concerned with trying to look a certain way on social media than building a business. And then they don't want to do it the right way. They want it fast. They want the hype. They want the look to, like you just said. I don't know how many times now these people get on social media talking about writing off your entire vacation and calling it a bit. You have one meeting and it's a business expense. And then when you call it out, oh, you just don't know how to do the tax code. You just don't know how to do the tax code. But then they end up in jail. Or they end up getting somebody caught up. All because they want, well, if you got a spouse and every time you meet, you can write all the meals off. Every time you go out, just talk a little bit about business. There are some things within the tax code that do provide advantages. It is not as easy or simple as what the internet gurus make you think. And I was talking to a guy the other night. He was telling about somebody he was listening to about tax strategy. And And I said, did you know that that person you listening to is not an accountant or CPA and don't have a degree in taxes? Why are you listening to this person? And then I sent them a real attorney who be chopping him up. He'd be killing him. But this is what people like to jump into. They want to get the hype. They get a whole lot of money at one time. Now I can go buy my Rolex and I can get on the private plane and take pictures. I can stand at Rick Ross' house and take pictures. All this other kind of stuff. We just got to get away from that. Moving on. Once you begin to issue shares, when people buy, you have to track it. Kyle mentioned it earlier. Back in the day, and you can still do it as well today, it was paper certificates. But you need a transfer agent. A transfer agent registered maintains your cap table. They process share certificates, track investor ownership, required by the SEC for all Reg CF offerings. Why do you need it? Because that ensures accurate shareholder records. They handle all the foreign filings, manage the investor communications, and maintains compliance with securities regulations. This is not a option. It's not a, oh, I only do it if I want to. No, you have to do it, because if you have millions of shares going around out there, you want somebody who's tracking it, and they're tracking it in a national database. So when people come calling what's due and you go public, people can know what shares they have and what they're worth.
Yeah.
Escrow agent. Any of my real estate investors out there, you know what escrow is. You know what it's all about. Even if you bought a home before, you know what escrow is. When you put down that down payment, it doesn't sit in just anybody's bank account. It sits in an escrow bank account. So what is it? An escrow agent is a qualified third party, a bank or registered broker dealer that holds investors' funds in escrow until your offering closes or the target amount is reached. It protects investor capital during the offering period. So no, the money don't go right into your bank account. It hits the escrow agent's account first. Must be independent. They can't be affiliated with you. They must properly transmit funds once the offering closes. And they must refund investor funds if the target is not reached. So in most cases, your funding portal or broker dealer will arrange escrow services through their existing banking relationships. The escrow agents typically handle automatically by your intermediary as a part of their platform services. Not all do that. Some will make recommendations, and then you go and set up your account like we did. We had to go and set up our own escrow account with a broker dealer agent. So choosing your funding portal or broker dealer. All Reg CF offerings must be conducted through a single SEC registered intermediary. That means you can't have two going on at the same time with two different people. You got to have one in one place. And the SEC just updated some rules in February about that. If you want to switch, you have to close that offering all the way down and then start over with a new Form C. So if you want to start in one place and move to another one, there's some work there. But here's some of the popular ones out there: WeFunder, Star Engine, Republic, Dealmaker. And so again, if you want to do a Regulation CF, you have to use a SEC registered intermediary, FINRA registered funding portal, or a broker dealer. Look at the platform track record. Investor fees. Some of them charge the investors fees to invest. Do they help you with marketing? Is there secondary market access? Do they specialize in your industry? There are some portals that only do real estate. There are some portals that do small business lending. There are some portals that focus on debt. Top three platforms, of course, WeFunder, Star Engine, Republic. They account for 80% of all Reg CF capital raised. So when you're talking about raising money, you can go to their sites and look at their offerings. Look at what businesses are doing, and look at businesses that are in your industry, so you can kind of model what they're doing so your raise can be successful. Required filings and disclosures. Before I go through this, I want to give the audience some time to just read over and look at it. Sean, Cal, talk to me a little bit about just disclosures, required filings, especially from previous capital raises that you guys done with the 504, and ones you've seen today.
Well, one of the popular disclosures, right, is that an investor can lose all of his money. I remember when I first saw it, it was like 95, 96. And I asked the SEC attorney, is this like necessary? He said, unless you want to go to jail, yes. And I was like, wow, is that serious? He said, yeah, because within the investment, an investor can lose some or all of their money. And so you have to have proper disclosure to let them know that it is possible. I mean, some of these disclosures paint a grim situation. It'll say words like fledgling company. It'll say words like capital. It'll say things like capital strapped, or something that I like. Without the key management, the company might not last long, or has a great chance of going out of business, or something like that. Without the capital needed, the company could likely go out of business. So, it will make an investor, a new investor, think twice, possibly, right? But it's just to protect you. Because if it's not in there and those things happen to your company, no matter how great your company is, companies go out of business every day. Look how many companies went out of business just because of COVID. So great companies go out of business every day. You need those disclosures to protect you, to keep people from suing you. And as long as you do everything you say you're going to do, it's less than likely for you to get sued later and for them to win.
Yeah, one of the, Sean kind of hit that nail on the head with the risk factors, and I remember in our PPM, by the time you got to page 10, you might have saw a risk factor 5 different times, in our PPM. And on the first page, risk factor, you could lose your entire investment, highly speculative, right there on the first page. And then after that, it said risk factor, see page 10. But all the way along, getting to page 10, there was other things that said risk factor, highly speculative. So that's there, like Sean said, to protect you when you're putting the company together. So when somebody turns around, they read your PPM or your Form C description, when they read that and go through it, then they sign off on it, that's CYA for you, okay? Because they signed off on it, they know it. Now, you got to make sure that you're dealing with a sophisticated investor. Because if you're not dealing with a sophisticated investor, they can go back and say, oh, well, you know what? Hey, I wasn't told, or I wasn't, they didn't share this with me. Well, yes, they did, because the first 10 pages, it said it 5 times. And not only that, but then you signed the subdoc. So yeah, this is basically, you're okay. And you'll be all right. And plus, you can protect them by being an unsophisticated investor. There's only so much they can invest. So that's, if they're a accredited investor, then it says that. That's another, statement it says there. Are they accredited investor? And you have to know what accredited investor is. So those are risk factors. If it's accredited investor and they know that they understand basically what the risks are, and they can put up the amount of money that they want. But I'll say this, make sure whoever you're dealing with, and it's up to you, even though they sign off on all that, it's up to you as a CEO or as a CFO, COO, whatever, to make sure that person's money who you're taking, is that a good investment for your company? All money ain't good money.
Mm. That's good, Kyle. So your Form C, that's your offering statement. You want that either drafted by an attorney or drafted by the portal itself. So some portals will have these documents that they can draft for you. Others are drafted by attorneys. So you always want a professional to draft this document, attorney reviewed, and then it gets filed with the SEC. So again, it has the business description and use of proceeds in it. It has financial statements in it, like the one we're going through. Our Form C is right now pending the audited financials to come back, and then they're going to put them in the Form C. The risk factors and ownership structure and executive compensation, if any. The Form C is your business pretty much background, all of it, and a an attorney that's worth their salt is going to fact check the things that you say that you did. Like, even Kyle, a good example, because I've been dealing with more of this. I had a graphic, right, that just said, I think it said 84 trillion, because they're talking all the language around $84 trillion in wealth is going to be passed in the next 10, 20 years, from the baby boomers down, civil rights, all of that. I had a graphic that just had 84 trillion with an arrow going up. Attorney said SEC don't like that because it looks like you guarantee you pushing up the way it could be construed. So they will go through and fact check what you're putting in that document, so to protect investors. So yes, your Form C statement is very important. Then we go to the Form CU, which is progress updates. So after each one of these update points, you have to file within 5 business days, 50% of the target, 100%, offering termination or completion, or material changes in offering terms. So you can't launch and then just go change it. You have to file paperwork to do that. The CAR is the annual report. So 120 days, within 120 days after the fiscal year end, you just want to include the financial statement, business operation update, and use of proceeds. Are you doing what you said you were going to do with that money? And so the good news is, depending on who your portal or broker dealer is or transfer agent, they will help you prepare and file all the necessary SEC forms. There are templates, compliance teams to make sure it's all done correctly. This is a question I get all the time. Well, what about what am I giving for people to invest in my company? And that's usually the language that's used because it's called security structure. These are securities for the Regulation CF. Some of the common ones are common stock, shares, and stock, one for one. It's the most popular choice, 60% of all Reg CF deals. Straightforward equity ownership, voting rights, potential dividends, clean cap table. Preferred stock, that simply means they have priority over common, may include anti-dilution protection, more complex. It attracts more sophisticated investors. Some will start to ask for that. A safe, which is widely used for popular for early stage companies, is a simple agreement for future equity. So it converts to equity at a future price round. Right now, it's not priced. You don't have it's 5 cents per share. It's just, it converts later. No interest rate or maturity date. It includes a valuation cap and or discount. And then convertible notes. Those are debt instruments that can convert to equity. Includes interest rate, typically 4 to 12%. 4 is on the low end, 12 is kind of up at that top. Has a maturity date, must repay if no conversion, is more protective for investors than safes. Now, that being said, there are other options because with a Reg CF, your security is very flexible. It's very flexible on what you can offer, how you can offer it, changes and nuances. This is why it's important to have a securities attorney, one that focuses on Regulation CF and other crowdfunding, Reg A's, Reg D's. Have an attorney that this is their specialization, because they can help guide you. They're not going to exactly tell you what to do. Nobody's going to tell you what to do, but they can provide guidance on the different alternatives and options for raising capital. Is your company ready? Now, I think this is probably the key slide that you want to pay attention to. This is what you need to do in order to be ready to raise. US-based entity, clear business model and use of funds, have some traction. Now, if you're brand new and you're a startup, your vision, your pitch deck, your idea, your $1 billion idea needs to be clear. Not planning a merger, no securities violations or disqualifications. They're going to do a background check. When you want to raise capital, you become what's known as an issuer. All issuers, all officers in that company, anybody that owns over 20% in that company, they're going to go through a background check. And if you have any securities violations or disqualifications, you possibly won't be able to do one. Legal and financial, so clean cap table, financials ready, operating agreement or bylaws in order, IP properly assigned, securities attorney available for guidance. I said this last night and I say this all the time. Your legal documents for your business, operating agreement, articles of incorporation, bylaws, stockholders agreement, tax returns, EIN letters, all of that needs to be in a folder somewhere, either physical or in the cloud. Have all of that in one place. You will need it over and over and over in your business. Over and over. You cannot do any of this without the documentation. So make sure that you put that in place. Marketing. So you either want an existing customer base or community, an email list, social media presence, compelling brand story, and a marketing budget. Let's go back to this. Nothing in business is free. Yes, it does sound, and I'm gonna stop right there because I want to ask this question, Kyle. I always feel this, maybe you and Sean can help me with this because I feel this a little bit too. When I first heard, why do I gotta pay money to raise capital? I need money. Why am I paying money? Give me the mindset shift that I need to make for that.
Right. How many times you heard the statement, it takes money to make money? Why do people think getting money is free? When you put your money in the bank, why do they charge you interest? You know, people don't realize that. They're making money off of your money, but you're only making 0.03%. How much are they making on your money? So in all actuality, the bank is charging you for the money they're making on your money. And then at that, they're only giving you a small percentage of it. But people do it. So if you got $1,000 in your bank account and it's there all year, you're going to get 0.3% on it. But yet, how much did they make? And then they're going to tell you a story. Oh, well, because we took your money and mixed it with the other people's money. So therefore, that's how we got a bigger percentage. Now, we can't give you that percentage, but yet they're getting a discount for taking all that money, putting it together, but then turn around and pay everybody just a little 0.03%. But they done made, gloop globs off of it. Oh, and by the way, do me a favor, Tyrus. I need to borrow $20. All right. But however, I'm going to give you back 17. Is that okay? How come every time you go to an ATM machine that's not your bank, they charge you $3? Sometimes 4, sometimes 5. But if you literally say that to somebody, hey, look, you know what? Yeah, I'm gonna basically, I'm gonna borrow $20 from you, but I'm only gonna pay you back 17. Who's getting that $3? Let's say you get $3 off of 1,000 people every day. That's the reason why bank vice presidents have them golden parachutes.
I know, Sean, you always say, you've been saying this ever since we kind of did that marketing meeting. If you put, X amount in and you're looking at getting X back, that's a no-brainer. Why is it so difficult for businesses to see? Is it because they're cash strapped? Is it because there's just some thought that if I'm raising money, I shouldn't have to pay to raise money? Like, where do you feel like that comes from? And you're on mute.
If you look at it like this, right? One of the best ways to build your company is to raise capital, right? Because raising capital can take you to another element in your business. As far as acquisitions and building your team up and et cetera, right? These platforms cost money, right? They're not free. So, especially for smaller companies, there is a cost because, again, they can't foot the bill for these platforms, right? These platforms they can get pretty expensive. If you buy them straight out, you have a business expense each month from running these platforms. So capital is needed in order to maintain these companies' platforms. Also, like Hal said, it takes money to make money. But if you look at it like this, just like I mentioned earlier, raising capital can change your business. It can get you from selling pens, right? Literally to, you know, buying jets, or selling books to buying jets and trucks and being the largest, you know, online uh, uh, retailer in the world. That's what it did with Amazon. Amazon went from selling books to buying planes, all from raising capital. If you look at it like that, that's the reason why capital is important. That's the reason why you should pay in order to raise as much capital as possible. And it's not like crazy fees. They're not charging you like, 500,000 just to raise $1 million. It might be 10,000, 15,000, 20,000, whatever. But in return, you have the opportunity to raise 5 million. Or if you do a 506c, you have the opportunity to do an unlimited raise. Everybody talk about how Starlink and all of these other, companies raise billions of dollars. Well, that's your opportunity. 506c, raise as much money as you want to raise. So that's what capital can do to your company, but you got to pay for it in order to get on these platforms.
Yeah, I like that. If
You know
I
what?
think about,
I want to add to that too. Jump on what Sean says. Think about this. And again, don't get me wrong. I'm not down in education or anything like that. I believe, education is the desired point or whatever, things like that. But we'll pay to go to college. We'll go in debt to go to college. We'll get student loans. We'll get credit cards, student credit cards or whatever. And, ain't got a job, but they'll give you a credit card. 10, 7 of them. And then when you graduate, how much are you guaranteed to make?
no guarantee.
And you might have spent $120,000 student loans or whatever. That wasn't free. So what is society telling us? You're going to college so that you could do what, really? Make more money, right? Be more educated in a field that you plan on working in, that when you get that degree, you probably won't be working in that field. Most people that have their degrees are not working in the field that they got their degree in. So when you think of it, we've been, again, bamboozled, told to do that, put yourself in all this debt, and then after that, you can't even get the job to basically help you pay that debt. So now you defer your student loans, and now that stuff follows you like the IRS.
Yeah, it do. And I like, when you think about a Reg D, the 506c, the unlimited capital raise from accredited investors only, general solicitation, you put money back into it to just get more money and more money and more money and more money. And I think that as business owners, we're used to reinvesting and putting money back into business. We don't pay ourselves. We got to put it back into business. We're taking the HELOCs out on the house. We're doing credit cards. We're doing this business funding. We're following all these people online, tell us to go get the bank money, $50,000, but we don't allocate it right. And that's the key. Is, again, this is another tool for you to utilize. Would I put 50,000 in for the opportunity to be able to make 2 million or to raise 2 million? You're put at the end of the day, you're putting money in somewhere anyway. Most of us are just putting in incremental amounts that go into an endless well that keep us trapped all this time. And we just don't see another way. One, because we're not told. Nobody's walking around talking about Regulation CFs and the Jobs Act and raising capital. And then when we hear it, it's so foreign. It's like, well, I can't do that. I don't know anything about that. Yet we listen to the same people that talk about Elon Musk and Jeff Bezos and Meta and all these other people raising capital, venture capital, private equity. We hear the language, but we don't ever put ourselves in the same position to do it when we can absolutely do it the same exact way that they do it. Now, we might not be raising billions of dollars, but we can raise enough to move our business to the next level. And so when you're thinking about your company and all
Can
you
I add
read,
something in real quick, Kyle?
yep,
I mean,
go for it.
Tyrus, in a lot of ways, I think raising capital is easier than getting a loan from the bank. Why? Because I don't got to worry about my credit. I ain't got to worry about, if my credit score is 110, 490, 310, whatever. I don't have to worry. If you have a solid business, people will invest, right? We were able to raise, what, 300K in how long?
You talking about recently?
Yeah, yes, yeah.
I mean, 2 phone calls, really.
2 phone calls. So how many people can get a bank loan that fast? And there's guys out there, there's people out there like way better than us as far as personalities and, charisma and stuff like that. And they have a knack for people and stuff like that. And they can talk to people and get them to buy anything. But 2 phone calls, you make 2 phone calls to the bank, you're just warming up. You ain't getting they ain't issuing no loans to you. And the great thing about raising capital, in a lot of times, like, especially if they're invested in shares, you ain't got to pay them back. You don't have to pay nothing back to them. So I just wanted to kind of make that point there.
Yeah, because everybody, is in for the liquidity event, the long haul. So it's not that 30 days later you got to start paying, especially if you do an equity raise. Now, if you do a debt raise, again, you have to make sure whatever structure you use, you structure it properly and know the terms that you're pushing out there. And so when you think about this raise, look at this, screenshot it. Are you ready? Do you have a management team that can dedicate 20 hours a week? Because it's work. I'm finding out, Kyle, when you raise capital and on that way to go in public, that Kyle said it. I didn't understand it. I understand it now. It's a business in itself. So you're going to have somebody else running the day-to-day of the business, because when you're raising capital and you're on that public and you're doing that side of the house, that is its own business within a business that you got to make sure that you're answering, sending back. I sent back some documents today that they needed signed for the audit. I'm like, how many more? Like, can you send me everything up front in one package? Nope. All these little small things that we need here and there. I'm like, can you put it in one? Send me one thing. I'd rather have one email with 100 documents than to get one email every single day for 100 days. But it's a business in itself. Do you have video production capabilities for the pitch? I was talking to a guy today that I recorded a podcast with. He was like, we're doing a pitch competition. You can apply for it in May. And then in June, it'll be in person, it'll be live. Investors will be there. And he was like, I love your setup in your office and your home. Do you have some video people that can travel with you to get that content? These are the things that are necessary. Investor relations capability. I would say Sean is more of our investor relations. He talked to all investors more than the rest of us. And do you have 60 to 90 days to really dedicate to the campaign? Really put your energy in it. I was on a call earlier tonight and people were talking about how busy they were. And I listened to that. I'm so busy in my business. But if you're so busy in the business, something's not quite right. It's not scalable. You're not fundable. You're not investable. So you got to think about that. So timeline, here, let's talk about the cost. Timeline and cost expected. So you're looking at about 12 weeks to launch. If you're really slow, it could be longer. It just depends. So you want to select your platform, agent, prepare your financials, get a CPA involved, create your pitch deck and video. That's probably needs to be done first. Get your drafted Form C, file it, launch, and then run the active campaign. If you're raising more than $1 million, you're going to probably need about 6, 8 months, 6, 9 months to raise more than that $1 million. So you got to dedicate that time. Estimated costs. So platforms typically they can charge a one-time fee plus a success fee of the raise, meaning they get a percentage of the raised capital, or they can just do flat fees. Every platform is a little bit different. That's why you got to investigate. Transfer agent is going to charge you some money to get set up, plus annual fees depending on the package that you selected. Ours was much lower than 2K because I didn't select some of the stuff they offer. We didn't need it. Financial review, I think this is going to hit you no matter where you go. That's that audited financial. I couldn't find one below 5,000. I couldn't find one. Most of them are sitting around 7, 10, 15. And as you grow bigger, going public, it's going to be even more.
There's more.
Way more. I be hearing the 50, 75, 100,000. But you've raised capital. You're bringing in revenue. You can afford it. You got to allocate the expenses in the business. Legal counsel, we all know that could be anywhere, depending on who the attorney is, what you're having them do for you. Marketing, when we talk about regulation crowdfund, general solicitation, marketing is a huge part of it. The data says and you can go to kingscrowd.com, and there are other sites that talk about crowdfunding, but the data says that you're usually going to spend around 10% of what you want to raise in your marketing budget. So if you want to raise $1 million, prepare to spend $100K. Marketing alone. Doesn't mean you're going to hit $1 million, but to even have a chance, you got to put that budget out there. And what's great about it is you can use this use of proceeds. So the money that you're raising, you can take some of that money out and invest it back into the marketing and the other things you need to make the raise successful. So you don't need all of this money up front. You need a good budget to start. So most successful campaigns, again, 8 to 12% of target raise for total cost. I'm seeing that number be more like 15%, maybe 20. Raising 500K, budget 40 to 60K. Many costs are success based. Platform fees only charged if you raise money. If they have flat fees or upfront fees, then you'll be on the hook for that. Common mistakes to avoid. Launching without a community. Now, I know we talked about startups and beginning from scratch, and you might not have a community. Well, your family and friends are your community. I heard, Kyle, that a guy said he's one of the, I would say, well-known marketers for Reg CFs, and he did a webinar. He said, Kyle, that if you're not willing to go through your telephone, your email address, and tell everybody you know that you're raising capital, don't do it. Don't do a Regulation CF, because that first round of community is going to come from your family and friends. And that's not so much different from when you first become a realtor. Most people sell their first house to family and friends. It's somebody you know. So you may not have a community based on your business, but you have a community based on your family and your friends. So don't expect to just jump out there and raise money without touching everybody that you already know. Poor valuation. If you're a brand new business, you ain't worth 100 billion. I don't care what your idea is. Don't do it. It'll kill momentum. Realists or sophisticated investors won't support you, and you won't be able to take off. Weak pitch video. So you want a video. Video is king. It's the number one conversion driver. You want to make sure that you have a solid 2 or 3 minutes showcasing what you're doing. Setting minimum too high. So if you're trying to raise 5 million, you have a minimum. let's say that minimum is 100 grand. Don't set the minimum to 2 million, because if you don't get it, you got to send that money back. Ignoring investor relations. So when you do start to get investments, you need to have at least, I would say, not in set in stone, quarterly updates. Let your investors know what's going on in the business. And then launching through holiday hours, that's a no-no. I mean, you might get away with it, but if you launching, ooh, best launch windows February through April, we right on time. We right on time. But you know, if you're launching through the holidays, people have holidays on the mind. They're not, everybody slows down. People aren't thinking about your raise when I'm thinking about Christmas. We almost there. Keys to a campaign success. Again, build your wait list. Line up some money and soft commitments, meaning test the waters. You can do a reservation page. You can't take money if your Form C hasn't been filed, but you can get interest. Are you interested in what I'm doing? Sign up here if you're interested, and just keep them in touch, or keep in touch, keep them updated. And when you go live, say, hey, we're live now. You can actually invest. Professional video, compelling pitch deck, email sequences for the launch, prepare social media content, because you want to push this out there. You want to show them. If you want to see a great raise that was done really well on social media, Isaac Hayes III with Fanbase. He was always on social media, pushing it. You got to brief advisors, the board for outreach, your board, they should be going out and talking for you. Set up investor FAQ document. Then during the campaign, you want to do social media posts, investor updates, answering questions that come rapidly, live webinars, press releases, retargeting warm leads with ads, leveraging testimonials, creating some urgency. Raise 30 to 40% in the first week to build momentum. So if you are starting out really slow, you got to make some drastic changes, because you want to raise that money and keep going. Cash follows momentum. And so screenshot this. We went over these pieces. This is your launch checklist. If you don't have all of these elements in place, get them in place, because you want to make sure that to be successful, you're not trying to get back and forth, or you don't want to half do it. Sharon sent a message to me today about, if we don't do X, Y, and Z, can we just focus on making sure the crowdfund raise is set up the best way it could be? And I said, absolutely. That's what we got to do, because I've talked to people who've done Reg CF raises and they weren't so successful. And when I asked them why, and they start saying certain things, you realize they just weren't prepared. Oh, I didn't do the social media. Oh, I didn't do paid ads. I didn't do X, Y, and Z. I didn't have my deck ready. So you launched and you weren't ready. It wasn't the Reg CF fault. It wasn't the instrument's fault. It was your fault. So make sure that you're prepared. Helpful resources, you can always go to the SEC Regulation Crowdfunding Guide. You can go to the EDGAR filing system to see other businesses that have filed. You can go to kingscrowd.com for data. Crowdwise.org has education. Service providers, transfer agents like Colonial Stock, Pacific Stock, securities attorneys, most platforms recommend them. If you need some securities attorneys or those that focus, you're welcome to email us, message us. We'll make some introductions. CPAs, look at funding portal blogs, LinkedIn groups, angel investor communities. There's a lot of information out there. You can always follow us, come to us. We speak this language. We opened up our community free for people to come on Wednesday nights. Show up, you'll get the information. And so once you go through the checklist, you got a clear roadmap from preparation through launch. Success in a Reg CF comes from thorough preparation, realistic expectations, community engagement, and consistent effort throughout your campaign. It's not a set it and forget it. So if you are planning, thinking, this might be in the cards for you, whatever you want to call it, start getting prepared now. That's all I got, gentlemen. What's your last thoughts? Things you want to leave with the people What should they be doing?
Yeah, that's good
I
stuff,
believe
Tyrus.
everybody should be thinking about. Wait,
Yeah, I'm saying that's good stuff, Tyrus. That's one of the main reasons why we started the Capital Raising Academy, to educate folks and teach them, to put things in place so that they would know. Again, we talk about it all the time. When Sean and I went public, 20 years ago, there was only 14 minority-owned public traded companies. Today, there's 6. With all this information, with all this technology, with everything out there, we're going the other direction. We're going backwards. What's the problem? And I believe right there, this checklist and everything is probably answering a lot of those questions. So good job.
Mr.
Good
Shaw?
Yeah, go ahead, Sean.
Oh, Shaw might be froze on us. That capital raising checklist got him shook.
Okay. Okay, yeah.
We'll give him a moment to come back.
Okay, yeah. But that right there, that's and to think that last year you didn't know all of this. So I want to just put the question back on you. Your journey through this process. I mean, what was it like? I mean, not only did you learn, but you got involved.
Yeah, so now Sean back. We got him back. So for me, having bootstrapped companies before, having borrowed from my 401k to I'm not getting on here telling a theory of what I think. This is what I did. Borrowing from my own 401k more than once, bootstrapping more than one company, credit card debt to keep real estate deals going, having borrowed or raised capital and really not knowing that I was raising capital from my first investor. With all that said, I knew there was another world because of Shark Tank. But I didn't know how to get in the world. I didn't know the entry point. I didn't know any of how to actually cross the bridge. I could see it. I could see on the other side of the bridge, but I had no clue how to walk the path until you guys told me about Capital Raising Academy, until I got in Capital Raising Academy, and until you guys made it real to say you can do just like what everybody else doing on the other side of that bridge. You can do it yourself for your business. And then I was thinking, wow, I would never bootstrap another company. And to take it another step, I don't even want to, and I don't want nobody to hear this and take it the wrong way. I'm not so focused on growing a business by customers only. When I can buy a business that has clients and customers and grow through acquisition. Like what you guys taught me and showed me about raising capital, about just the going public, acquiring businesses, it simplified the process so much more. And I feel like the Reg CF simplifies the process even more. Now I don't have to go talk to 100 different investors. I can launch a campaign online, run paid ads, be out there talking, selling the story, pushing the story, and people can go and invest. If you look at it, it's almost like one-to-many sales. Like everybody's telling you to do a webinar so you can sell to a bunch of people at one time. I think that's the key. Businesses, we don't see as small business owners, we don't see that everything we're doing right now in the business, if we directed that attention to raising capital, it's the same energy and effort. And it's often easier on the raising capital side. So that's what I took from it. Not knowing a year ago all of the pieces to today, understanding the pieces, and then appreciating the journey, but wishing I didn't have to go on it. Wishing I had to do it that way.
Outstanding. Go ahead, Sean.
Now, let me just say this last thing. You know, we're always taught to, invest in all these different companies, right? And my thing is, everybody want to tell us how to invest like Warren Buffett, invest like Elon Musk, but they never tell us to raise like Warren Buffett, raise capital like Elon Musk. They never tell us that. They always tell them to buy. They always tell us to buy like them, buy the stocks like them, mirror your stocks. But they never tell you to raise capital like Elon Musk. That's all I got to say.
I think that's a mic drop. I don't know if they understand it. I don't know if they get it,
That's good, Sean.
but I get it and I understand it. And if you don't get it, get into our community, capitalraisingacademy.com. Watch the webinar of how Sean and Kyle took their company public and join up with us so you can get the information. And again, it's another tool in your tool belt. Sean hit something right there that we see every single day. People telling you to go put your money in the market in somebody else's company, but they never tell you that you can have people put money into your company and that you can be on the market too. Just like they can. You can be on the market too. And we're actually doing an inside training in our group next week about the 6 different ways to go public. 6 different ways to go public. So for everybody that doesn't know how to go public, there are ways, 6 different ways that you can take your company public. It's about shifting your mind. At some point, you got to get away from the grind and the hustle and the. I was talking to another guy, just started working with another company, and they're grinding. Like, I'm on the phone all day. Elon Musk grind, but he grind in a different way. It's a whole different level. They're like, okay, he's sleeping in the office working 15 hours a day, but he's a billionaire, almost on his way to being worth trillions. It's a different grind at a different level. And so to Sean's point, you're hearing what everybody's telling you to do for every other business. You can do that for your own business. So that's all we got, good people. We're going to let y'all get out of here. We appreciate you for joining us tonight. Regulation CF crowdfunding. We gave you a step-by-step. Rewatch it, share it with other people so they can watch it. Every small business should at least know that this tool exists for them. And if you want more information, go to capitalraisingacademy.com. Watch the webinar, and we'll see you on the inside. We'll see y'all next week.